Welcome back to the Michigan Business Beat, brought to you on the Michigan Business Network. Chris Holman here, and we're recording from our remote studio in the garden level of the Holman house, as a matter of fact. But we're going to run kind of cross country, actually, all the way to Pittsburgh, PA. Our good friend Kurt Rankin, Vice President and Economist for the PNC Financial Services Group, joins us as always. And Kurt, it's always a pleasure to have you here, and just wish I could get you in town. I know I owe you a round of golf, and I wrote it down.
It's nice to see you too, Chris. Nice to actually see you as opposed to just on the phone.
Yeah, it is kind of crazy. People are coming out again. It's kind of neat. Kurt, it's the end of the first quarter. I guess I need your expert opinion. Where is our economy at?
Well, the economy is starting to show, I don't want to say cracks, because that implies there might be a downturn impending, but we got some consumer spending numbers, which seem to be reacting to inflation in a negative way, slowing down. Not declining so much yet. We're still up big year on year, but it seems like inflation is hitting consumers and their willingness to spend, and the reserves, the number that came out this morning, savings in other words, is down now to below the 7% numbers we were seeing prior to the pandemic. So not only are incomes being eaten away live by inflation, but savings are starting to see the hit.
Kurt, do you think because we pumped a lot of money into the individual's hands, and even in many cases businesses with PPP, that sort of thing, do you think that caused the surge and now they've spent that money?
That's plays a part, but really the reason for the surge, I think, is just supply and demand. There's a lot of demand. We see the unemployment rate now below 4%. Remember, prior to the pandemic, it was 3.5%, and that was considered untenable. So now with labor shortages, continued supply chain shortages, there's a lot of demand chasing very limited supply, and the ability of the U.S. industrial base to catch up with that demand is waning. If we continue to add as many people to the labor force as we have been adding by mid-2022, we may well be at full employment and not be able to squeeze any more people into the labor force to help catch up with those supply chain disruptions.
Now, this is a problem we have, and a lot of it is just pure arithmetic. We don't have enough people coming into the workforce to replace those leaving. Let's talk a little bit more about that supply chain. Is that starting to catch up? Are we getting movement in the right direction or not?
We're seeing movement in the right direction. We're starting, however, to see pressures from elsewhere. Of course, the conflict in Ukraine is going to put pressure on food prices as we go through into the summer months. Oil prices have already seen a rise. Transportation was already by far the leading component pushing inflation in terms of double-digit year-over-year price growth. That, of course, is new cars, used cars, fuels. So there seem to be pressures. While we're gaining in some areas, we're seeing pressure build in other areas. So I think inflation should remain above where it is through the end of this year, up around even 4% to close out the year still.
Well, it's interesting because our latest Michigan Future Business Index came out, and it showed talent was still the number one issue, getting talent. Well, what happens when there's a shortage of talent? You and I both know you have to pay higher to get that talent in there. Number 3 was wage inflation. Talk a little bit about that.
You just said it. Supply and demand also applies to labor markets, and with a shortage of workers, either qualified or even the workers that you're willing to train, there seem to be limited number of people re-entering or willing to enter the labor force. Hopefully some of that eases now that the worst of the pandemic does seem to be in the rearview mirror, but PNC's forecasting the labor force participation rate still down 1% from the pre-pandemic equilibrium. So that means about 1.5 to 2 million workers not coming back into the labor force. Higher weight that results in, if you're going to attract or even retain your existing talent, that means we've got pressure on wages upward. Those upward pressures are going to mean more costs for businesses, and that means those businesses are going to charge consumers more. And I don't think wage pressures are going to go away any quicker than inflation is.
Well, a little warning to the business community, just because you're full staffed right now doesn't mean you're going to remain that way, because people are hunting your people as well. Let's
Indeed.
talk a little bit about interest rates, because we keep hearing what the Fed is thinking, and we're looking at bumps in the future. Do you concur with that?
Yes, we're forecasting the Fed funds rate, the monetary policy rate, to tighten another 5 times this year, including a couple of 50 basis point hikes. And then again, early in next year, the Fed's going to continue fighting inflation, have to continue fighting inflation. As I mentioned, if inflation is up above 4% and their target's 2%, then we're looking at the Fed raising rates all the way through early 2023. And it's a tightrope for the Fed, because they're in a position that I can't recall them being in my career. It's if they don't tighten, inflation is not slowing down. The Fed has to do this, but of course, tighten too aggressively. You bring interest rate risk back on the table, something we haven't seen over the past decade and a half, really. And businesses start to pull back. They're not willing to take on the risk. So the Fed will be tightening in response to inflation. I think that's the right move, but there's of course downside risks that come along with that as well.
Well, a lot of other factors in there, let alone what's going on, in other countries. So, Kurt, thanks so much for jumping in with us. We appreciate that. It's always good to spend time with you, buddy. Kurt Rankin, Vice President and Economist for the PNC Financial Services Group in Pittsburgh. And we'll look forward to more in the near future, I hope.
It's Chris. Take care.
All right. I'm Chris Holman, and you are watching the Michigan Business Beat on the Michigan Business Network.